SpaceX just announced a $100 billion rocket base in Louisiana, and the first launch is not scheduled until 2029. That gap is the entire investment story. Enormous capital spending today, uncertain cash flows later, and a public stock already trading close to its $135 IPO price. SpaceX says Starbase Louisiana will be its fourth and largest launch site, a 125,000-acre project designed to support thousands of Starship flights each year. Reuters says construction is planned to begin in 2027, and the first Starship launch from the site is targeted for 2029. Those are company plans, not delivered revenue. For investors, the question is not whether a bigger launch site sounds impressive. The question is whether Starship can turn cadence connectivity and government demand into economics that justify the build-out. The announcement came as SpaceX kept flying its existing machine. Starlink 1522 launched 27 satellites from Vandenberg, and booster B-1082 was scheduled to land after its 24th flight. That is the contrast to watch. The Louisiana base is a future capacity bet. Falcon 9 and Starlink are the current operating base. The day before, Spaceflight Now reported another Starlink mission using a booster on a record 37th flight. Reuse is no longer just a technology demonstration, it is becoming a production metric. Every additional flight test inspection, refurbishment, turnaround time, and the ability to spread hardware cost across a larger mission base. The planned Louisiana complex is built around Starship, not just Falcon 9. SpaceX describes a site with launch complexes, propellant production, power systems, vehicle processing, shipping infrastructure, and an airport. That is effectively a bet on vertical integration. If the same company controls the vehicle, the launch site, the network that creates demand, and the customer relationship, it can coordinate decisions faster than a stack of contractors. The trade is that the company also carries more of the cost, more of the schedule risk, and more of the consequences when one system slips. A Louisiana location could also change the geography of that system. Coastal access supports large vehicle movement and range operations, while proximity to industrial power and shipping links can reduce friction for a high-throughput site. Those benefits are potential advantages, not guarantees that the launch economics will beat every alternative. The important distinction is between capacity and utilization. Capacity is what the site can theoretically handle. Utilization is how often customers pay to use it. Investors should watch both. That list matters because launch cadence is a systems problem. A rocket can be ready while propellant, range access, ground equipment, or recovery logistics are not. SpaceX is trying to solve the whole chain before the flight rate arrives. It is building the factory, the range, the transportation links, and the operating rhythm in advance. The official ambition is thousands of Starship flights per year. That is a scale target, not a current run rate, and the difference between those two numbers is where execution risk lives. There's also a near-term operating signal. Spaceflight Now reported that Florida's Starlink cadence is pivoting toward future Starship operations, while Falcon 9 continues to carry the network today. And NASA has a visible near-term catalyst. The Nancy Grace Roman Space Telescope is targeting a Falcon Heavy launch on August 30 after arriving at the SpaceX hangar on August 25th. Roman is not a Starship revenue event.
It is evidence that SpaceX can keep its existing launch and government pipeline moving while the next platform remains under development. Now, connect the physical plan to SPCX. TradingView's August 26th capture showed SpaceX at $137.95 after a 2.19% gain, with extended trading near $136.91. The screen is dated and not a live quote. That price sits close to the $135 IPO reference point and well below the roughly $225 early peak documented in the local investment reference. The stock has already forced investors to debate whether the IPO priced a business or a future. The bullish case is a platform stack. Starlink can monetize connectivity. Falcon can monetize access to orbit. Starship could expand launch capacity and enable larger payloads. A massive new site could make that capacity repeatable. The value of the base is therefore not the concrete and steel by themselves. It is the option to lower the cost of each future launch by increasing throughput and reducing operational bottlenecks. If Starship works as planned, the base could support more Starlink satellites, heavier government payloads, lunar missions, and an emerging market for large orbital systems. But do not convert that list into a revenue forecast. SpaceX's announcement describes planned investment and capacity. It does not disclose a guaranteed margin per launch, a contracted Starship flight schedule, or a return on the $100 billion. MarketBeat's page displayed a moderate buy consensus based on 41 analyst ratings and an average 12-month target of $220.20, with a $75 low and $800 high. That range is not precision. It is a visual of how wide the debate remains. The analyst spread also tells you what kind of security this is. The market is not pricing only current launch revenue. It is assigning value to multiple future businesses at once. That creates operating leverage if execution is strong. It creates fixed cost risk if capacity arrives before demand, or if Starship delays keep the new site underused. And SpaceX does not exist in a vacuum. The same capital pool includes Rocket Lab, AST SpaceMobile, Intuitive Machines, Iridium, and Firefly. On this pre-market snapshot, RKLB was $66.91, and ASTS was $62.01, both lower than the prior close. A stronger SPCX moat can validate the space category while pulling attention and speculative dollars toward the largest platform. That is a sector-level trade-off, not proof that smaller companies lose. The investor has to ask which cash flows are repeatable now, which depend on a milestone, and which exist only as optionality. Risk 1 is capital intensity. A $100 billion commitment is a statement of ambition, not a guarantee that every dollar creates shareholder value. Large infrastructure can become a moat, but it can also become a long-duration cost center. Every year of delay pushes the cash payoff further away while construction and maintenance costs arrive first. Risk 2 is Starship execution. The 2029 first launch target is a target. The flight rate, reuse cycle, payload economics, and regulatory approvals still have to be demonstrated. Risk 3 is demand. Thousands of flights per year require thousands of economically valuable missions, not simply the physical ability to launch that often. Starlink creates an internal customer, but internal demand still has to convert into subscriber growth, network economics, and durable cash generation. Risk 4 is concentration. A single company, founder, launch architecture, or regulatory decision can influence multiple businesses at once. Risk 5 is valuation.
MarketBeat's $75 to $800 target range is a warning that the model depends heavily on assumptions investors cannot verify from a launch photograph. The clean read is disciplined. A successful launch proves capability, not payback. A new base proves ambition, not revenue. An analyst target proves sentiment, not intrinsic value. The bigger question is whether launch becomes the utility. If it does, the advantage may belong to the company that can schedule, finance, launch, connect, and service the most hardware with the fewest handoffs. Starbase Louisiana is an attempt to build that utility before the demand curve fully arrives. That is why the plan is strategically important and financially dangerous at the same time. The bullish outcome is a flywheel. Cheaper launches add more Starlink capacity. More capacity improves recurring connectivity revenue, and that cash supports a larger launch and space infrastructure platform. The bearish outcome is a different loop. Construction runs ahead of demand, Starship slips, capital needs rise, and investors pay for optionality that keeps moving to the right. For SPCX, the next evidence is not another headline. It is visible progress on site construction, successful Starship flights, repeatable turnaround, contracted demand, and cash conversion. For the rest of the sector, the question is whether capital rotation creates a discount on specialists with their own repeatable economics. RKLB and ASTS are not SpaceX substitutes, but their prices can still be moved by the same pool of investors. So here's the question. Does a $100 billion Louisiana base make SpaceX look more like a launch company or more like an infrastructure utility? Watch the construction, the cadence, and the cash. Nothing in this video is financial advice. This is for educational and entertainment purposes only.